Today we are going to see corporate accounting in that internal reconstruction. First, we shall see what is the meaning of internal reconstruction. So, in case of internal reconstruction, the company's existing financial structure is reorganized without dissolving the existing company and without forming a new company. So, taking the meaning of the term internal reconstruction, it includes alteration of share capital and reduction of share capital, variation of shareholding rights, scheme of comprise or arrangement. And let's move on to difference between internal and external reconstruction. So under internal reconstruction, there is no winding up, no new formation, no sale of business, no purchase of business. The assets and liabilities are revalued through capital reduction account. Profit and loss account, debit balance, and fictitious assets must be written off against capital reduction account, even if the question is silent on this point. If the final balance in capital reduction account is debit, it should be transferred to goodwill account. If there is a credit balance, it should be transferred to capital reserve account. An external reconstruction is a type of amalgamation where a newly formed company take over the business of an existing company. Then, meaning of capital reduction. It is the repayment or writing down of a company's different classes of capital as a result of large accumulated losses or an excess of funds without profitable use. Though capital reduction may be effected when a company accumulates huge surplus funds far in excess of its requirement, but it is more usually followed when a company passes through a period of financial difficulty, accumulated losses, or has its asset overvalued. Then coming to objectives of capital reduction, when new capital has to be introduced to revive a company, the success of new issue would, however, almost certainly jeopardized by the existence of accumulated losses. Therefore, it is prudent and usual to write off these losses by putting a reconstruction scheme into effect. The objective of capital reduction is the resumption of the payment of normal dividend out of the expected future profit without the necessity of using those profit to write off the debit balance of profit and loss account. And what are the procedure? That is, according to the Companies Act, the company must be authorized by its articles of association to reduce share capital. If there is no provision in the articles in this respect, it must pass a special resolution to alter its articles of association. It should be noted that an authority to do so contained in the memorandum is of an no avail. The company must pass a special resolution to reduce the share capital. The company must apply petition to the court for an order confirming the reduction. If the court is satisfied that the creditor's interests have been secured, it may confirm the reduction. However, it may impose terms and conditions, including a directors, that the word and reduced should be added after the name of the company for a certain period of time and that the company should publish the reason for such reduction. Then, the company has to deliver to the registrar a certified copy of the court order and minute approved by the court showing the details of the shares for registration. The registrar will then register the order and minute. After registration of this, the resolution to reduce the share capital shall take effect. Notice of registration shall be published in such a manner as the court may direct. Form, the reduction of share capital may take any of the following form. That is, the company may reduce the liability of the shareholder in respect of any unpaid amount. The company may pay off any paid up share capital which is in excess of its requirement. The company may cancel any paid up share capital which is lost or unpresented by available asset. And the reduction of share capital may take any of the basis like the present position of the company is bad but future is good. There must be better prospects if the scheme is being implemented. The scheme must be approved by the shareholders and the creditors. Further contribution must be made by the shareholder and creditors for the purpose of working capital. So these are some information and introduction about alteration of share capital and about internal reconstruction. Hope you all understood this video and we shall see remaining topics in the next video. If you like this video, please subscribe, share with your friends. Thank you.